Are rising interest rates shaking up the stock market? You've probably seen the headlines, but what does it all mean for your investments? In today's video, I'll break it all down for you, why it's happening, how it impacts the market, and what you should do to stay ahead. Let's dive in. 1. How interest rates impact the economy and stock market. First, let's understand the chain reaction caused by government debt interest rates. When these rates go up, it affects almost everything. Mortgage rates, auto loans, credit card debt, business loans, and when these rates go down, so do the others. For now, we'll focus on the stock market. Let's look at how interest rates influence investor decisions with two simple examples. Low versus high interest rates, a simple comparison. Low interest rates. Example, 0%. Imagine treasury bonds and bank savings accounts offer 0% interest. As an investor, would you choose to earn nothing on bonds or savings? Or would you invest in the stock market to seek higher returns? Conclusion, low interest rates are great for the stock market because they make it the most attractive option. High interest rates. Example, 20%. Now, imagine treasury bonds and bank accounts offer a whopping 20%. Would you risk money in stocks or go for the guaranteed 20% return? Conclusion, high interest rates are bad for stocks because they offer safer high return alternatives. Key takeaway. The key takeaway here is competition. Cash, bonds, and stocks compete for your money, and you'll naturally invest where you get the best returns. Higher government debt rates shift that balance away from stocks. Why the 10-year Treasury yield matters. One of the most important numbers to watch is the 10-year Treasury yield. It directly impacts key interest rates like mortgage and serves as a benchmark for market conditions. According to Goldman Sachs, when yields hit 5%, that's when rising rates historically become a big problem for the stock market. Why are Treasury yields so high? Here are 3 key reasons driving higher yields right now. 1. Higher inflation expectations. Investors demand higher rates to offset inflation risks. For example, why settle for a 3% CD if inflation rises to 5% or more? 2. A resilient economy. While the economy isn't booming, it hasn't collapsed, reducing the urgency for rate cuts. 3. Falling foreign demand. Countries like China and Japan are reducing their U.S. Treasury holdings, while the supply of bonds continues to grow. What should you do? So, what's the smart move for investors? Stay calm. Don't panic sell during market dips. Think long term. Stick to your strategy and dollar-cost average buy small amounts consistently. Avoid leveraging. Don't borrow money to invest. It's risky in volatile times. Many investors see market pullbacks as opportunities. If stocks dip, think of it as a chance to buy quality investments at a discount. The Federal Reserve's role. The Federal Reserve has significant influence on short-term rates, but less control over longer-term yields. However, if rates rise too high, they could step in with emergency measures like rate cuts or quantitative easing. Remember, in the long run, stocks generally go up. Stay patient, stay informed, and don't let short-term turbulence shake your confidence. What do you think about the current market situation? Drop your thoughts in the comments below. I'd love to hear your take on this situation. Let me know in the comments, and if you found this video helpful, don't forget to like, subscribe, and hit the bell for more insights into investing and the markets. Thanks for watching, and I'll see you in the next one.